Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and a big move in 10-year note yields going back just a week ago. We were talking about maybe possibly seeing yields go back to 3%. And lo and behold, we didn't see that. We saw yields go the exact opposite way. We broke out of the range, made a new year-to-date high, made a new highest weekly settle, I think, since going back to April of 2011. 10-year yields got north, very close to 3.25, and that was really the talk of the week, is that this shift in yields is now, technically speaking, has broken us out of the range and likely will extend. All that talk about hearing, going back to 2.5 to 2.75 yield is gone, and there isn't even a mention of it. And I think right now you're focusing on how high can they go before year end. There was some speculation. A few modest speculators who had spoken out and said 3.5% 10-year yields are possible are now looking like geniuses. And I think that ultimately this will slow a little bit. The push, the sell-off in treasuries, the rise in yields will slow, but ultimately, how high can it go? I think right now we'll find out over the coming weeks, because as we absorb the data we got today, it was good data from the non-farm payroll side, but it wasn't great. It was better on the private side when we got the ADP number on Wednesday, but ultimately treasury yield momentum is really picked up. So right now we hit a multi-year high going back to 2011. That is going to stand at least for a while until we get another catalyst event, which could push us up. And maybe it'll be a Fed speaker, maybe it will be some more data, maybe it will come out of left field. But ultimately right now yields are moving higher, and that is a fact, and we're out of the old range, so we're going to have to start talking about a new range. And if you look at market volatility, a significant bounce from what we saw last Friday, and as to be expected, we broke out of the range. We took away the norm. Now we're kind of out in outer space. So market volatility higher in treasury space. Yeah, we talk about the flash crash in the VIX, but the VIX was higher as well as equities sold off. But I think ultimately, if you're looking at bond volatility, it's been missing for so long that it is welcomed now with open arms. Just the idea that we're going to have a new range to trade, or the idea that perhaps there's maybe some uncertainty in the market, I think will generate a lot of interest. And right now, the marks that we're seeing, we've seen these levels of volatility before, but we haven't been there in about 3 to 4 months, and likely on our way higher if yields continue lower. And then let's look lastly at the positioning. We did see the leverage funds, who are really the ones who have been short for this entire move. Even as yields went lower and higher, they've held on to those shorts, and now they've been rewarded. We did see some of those leverage funds cover ahead of the non-farm payroll number, but I can probably assure you that they were the first ones back in the market when things broke down. And right now, I think that will continue. We will continue to see those shorts add on, only given the fact that we heard from Chairman Powell, who talked about the need for higher rates, the need for finding the neutral level, not being there yet. Likewise, I think that when you look at the jobs numbers, yes, they're positive, and the inflation numbers that are looking better or looking higher, all that fuels higher yields. So right now, I think that the momentum has really shifted. We're outside the range. How long can this be sustained? There are certain of geopolitical catalytic events that could shift this. But on an economic and a fundamental level, bonds are very bearish today. This is Todd Colvin coming to you from the floor of the CME Group.